Here's a sentence that should mess with your head a little. The bank holding your paycheck right now is legally allowed to operate with less than 11 cents of its own money behind every dollar it plays with. Not 90 cents, not 50 cents, sometimes less than a dime. If you ran your personal finances that way, your family would stage an intervention. But when a bank does it, we call it Tuesday. So today, we're cracking open the economics of owning a bank, because once you understand how this machine actually works, you'll never look at that beige building on Main Street the same way again. It is part magic trick, part high-wire act, and part legalized casino. And somehow, it's also one of the most heavily protected businesses on the planet. Let's start with the dumbest, simplest way to describe what a bank actually does. Because underneath all the marble columns and the mobile app with the fingerprint login, a bank is just a spread business. It borrows money cheap and lends it out expensive, and it pockets the difference. That's it. That's the whole business model. When you put money in a savings account, you are lending money to the bank, and the bank is paying you almost nothing for the privilege, something like 0.5%, maybe 1% if you shop around. Meanwhile, that same bank turns around and lends your money out as a mortgage at 6 or 7%, or as a car loan at 8%, or as a credit card balance at 22% if you're having a rough year. The gap between what a bank pays you and what it charges someone else is called the net interest margin. And right now, across the entire American banking industry, that gap sits at roughly 3.25%. Doesn't sound like much, right? Except banks aren't doing this with a few $100s. They're doing it with trillions. 3% of trillions is not a rounding error. It's an empire. But here's where it gets genuinely wild. And this is the part most people never think about. A bank doesn't actually need much of its own money to run this spread business, because it's not really using its own money at all. It's using yours and everyone else's. This is where leverage enters the picture. And leverage in banking isn't just aggressive, it's baked into the legal foundation of the entire industry. Regulators require banks to hold what's called a capital ratio, which is basically a cushion of the bank's own money set aside to absorb losses before depositors get hurt. Under the current rules, banks need a minimum total capital ratio of around 8% of their risk-weighted assets, plus an extra buffer on top that pushes the real floor closer to 10.5%. There's also a simpler backstop called the leverage ratio, which just asks, forget the risk weighting, how much actual capital do you have compared to your total assets? And the bare minimum there is 3%, with bigger, more important banks required to hold 5 or 6. Do the math on that. A 3% leverage ratio means a bank can theoretically support over $30 of assets for every $1 of its own capital. Most banks don't run anywhere near that thin in practice. But even a healthy, well-capitalized bank might be operating at 10 or 11 times leverage. Compare that to a typical company, which might use 2 or 3 times leverage if it's being aggressive. Banks are playing an entirely different game, on entirely different rules, and they're allowed to because of what they promise in return, which is stability, oversight, and a government-backed safety net. Now, where does all that money banks are lending actually come from? This is the part that blows people's minds the first time they hear it, because most of us assume a bank takes deposits, puts them in a vault, and hands them back out one at a time, like a very slow, very formal library. That's not what happens. When a bank makes a loan, it doesn't dig into a pile of existing cash and hand it over. It essentially creates new money by typing a number into your account. That loan becomes a deposit somewhere, which becomes the seed for another loan, which becomes another deposit, and so on. This is sometimes called the money multiplier, and it's the reason the total amount of money circulating in the economy is dramatically larger than the physical cash that actually exists. Banks are, quite literally, money creation machines, operating under license from the government, with regulators keeping a hand on the brake so the whole system doesn't spiral into either a credit binge or a credit freeze. It's a strange thing to sit with. Every mortgage, every business loan, every dorm room credit card is, in a very real sense, money being conjured into existence and then slowly unwound as the loan gets paid back. Interest spread is the headline business, but if you only look at that, you're missing half the picture, especially for the giant banks you've actually heard of. Fee income, sometimes politely called non-interest income, is the other engine, and for the big money center banks, it can matter just as much as lending. This is overdraft fees, ATM fees, wealth management fees, the tiny slice a bank takes every single time you swipe your debit card at a coffee shop, investment banking fees for helping companies go public or merge with each other, and asset management fees for handling somebody's retirement account. This is genius from a business standpoint, because interest income rises and falls with the economy and with interest rates, which the bank doesn't control, while fee income tends to be steadier and comes with far less risk attached. A bank that only made money on the spread is exposed every time the Federal Reserve sneezes. A bank that also collects a small toll on every transaction, every trade, every advisory deal has built itself a second, sturdier leg to stand on. That's why the biggest banks in the world look less like a corner lending shop and more like a toll booth with a hedge fund attached. So if leverage is this extreme and banks are essentially creating money out of loans, why doesn't the whole system collapse every other Tuesday? The answer is regulation, and specifically a global framework called Basel III, which came out of the wreckage of the 2008 financial crisis, when the world discovered exactly what happens when banks get too clever with too little capital. Basel III forces banks to hold higher quality capital, mostly common stock and retained earnings, not just clever financial instruments that look good on paper and evaporate the moment things get scary. It layers on liquidity requirements too, forcing banks to keep enough genuinely cash-like assets on hand to survive a full month of a bad scenario without needing a bailout. It adds stress tests, essentially forcing banks to prove, on paper, that they could survive a simulated depression and still be standing. All of this is expensive. All of this eats into profit, and banks complain about it constantly. But it's also the reason your deposit is safe, even though the bank is legally allowed to be leveraged like a hedge fund on a bender. Regulation is the seatbelt. It doesn't stop the crash from happening, but it decides whether you walk away or don't. And if you want proof of what happens when a bank quietly ignores the spirit of that seatbelt, look at Silicon Valley Bank in March of 2023, because it is genuinely one of the cleanest case studies in modern financial history. SVB was the 16th largest bank in the country, and it had built its entire identity around one single industry: technology startups and venture capital. During the pandemic boom, tech companies were flush with cash and dumping billions of dollars into their SVB accounts. SVB took a huge chunk of that money and, trying to earn a little extra yield, parked it in long-term government bonds and mortgage-backed securities. Totally safe assets on paper. The kind of thing regulators love. Except there was a catch buried in the fine print of how interest rates work. When interest rates rise, the market value of existing long-term bonds falls because nobody wants to buy your old bond paying 2% when the new bonds are paying 5%. SVB was sitting on a mountain of these low-yield bonds right as the Federal Reserve jacked interest rates up from near zero to almost 5% in about a year, the fastest tightening cycle in decades. Suddenly, those safe bonds were worth billions less than SVB had paid for them. At the exact same moment, the tech industry hit a rough patch. Venture funding dried up, and SVB's startup clients started pulling money out to cover payroll. SVB had to start selling those depressed bonds at a real loss just to cover withdrawals, which spooked everybody. And because the vast majority of SVB's deposits were way over the $250,000 FDIC insurance limit, there was nothing stopping a full-blown stampede. On a single Thursday, depositors yanked $42 billion out of the bank. $42 billion. In one day. By Friday morning, regulators had seized the bank. Total time from functioning institution to complete collapse, about 44 hours. The whole disaster traces back to one lesson that every banking student learns in week one, and that SVB somehow forgot in real time, which is that you should never borrow short and lend long without managing the mismatch, because the moment everyone wants their money back at once, you are exposed, no matter how safe your assets technically are. Given all of this, the leverage, the risk, the regulatory gauntlet, You'd think starting a bank would be a terrible business idea. And yet, people are still lining up to do it. Because on the other side of all that pain sits a genuinely excellent, protected, wildly profitable business. Here's the twist, though. Actually, getting in the door is brutally hard. And that difficulty is precisely what makes the businesses on the inside so valuable. Applying for a brand new bank charter in the United States often costs well over $1 million, just in legal, consulting, and application fees before you've made a single loan. You typically need tens of millions of dollars in starting capital just to satisfy regulators that you can survive a bad year. The approval process can take years, sometimes literally 4 or 5 years of back and forth with multiple regulatory agencies. It's no surprise that new bank formation in America is sitting near historic lows. This is what economists call a moat, and it's not an accident. Regulators intentionally make it hard to become a bank because the alternative, a world where anyone can create money and take deposits with a laptop and a dream, is genuinely dangerous. But the side effect is that existing banks get to operate with far less competition than almost any other industry you can name. And that scarcity is worth real money. So how profitable is this whole strange arrangement at the end of the day? According to the FDIC's most recent numbers, the American banking industry closed out last year with a return on assets of a little over 1% and a return on equity above 11%. Translate that out of finance speak, and it means for every $100 of shareholder money sitting inside a bank, that bank generated more than $11 of profit in a single year. And it did it in an industry protected by sky-high barriers to entry, backed by a government safety net, and structurally impossible for a random competitor to just wander into. That's a phenomenal, almost unfair return, especially once you remember the underlying leverage means banks are earning that return on assets that are mostly other people's money to begin with. So, here's the real picture. A bank is a spread business, wearing a very serious suit. It borrows your money for almost nothing, lends it back out for a lot more, multiplies that money several times over through the simple act of lending, layers a second business of fees on top for good measure, and does all of it using far more leverage than any other legal business on earth is allowed to touch. The only reason this doesn't blow up constantly is a thick wall of regulation that most people never see, and most bankers quietly resent. And the only reason new competitors don't flood in to eat that 11% return is because the wall protecting depositors doubles as a wall protecting profits. Silicon Valley Bank forgot the risk was real for exactly 44 hours, and it cost the FDIC an estimated $20 billion to clean up the mess. So the next time you swipe your card, or roll your eyes at a 2% savings rate, or watch a beautiful new bank branch go up in your neighborhood, remember what you're actually looking at. Not a building, a licensed, leveraged, government-protected money machine, quietly running one of the oldest tricks in finance. Borrow cheap, lend dear, and try not to get caught when the tide goes out. If you found this video valuable, leave a like, subscribe, and comment below which business you want me to cover next.